April Stock Market Outlook. March offered U.S. stock market investors sweet relief following a forlorn January and February. The S&P 500 rose 3.6% in the month, offering a degree of recovery from a painful correction during the prior 2 months in which stocks had dropped as much as 13% from all-time highs. For the first quarter of 2022, all major stock benchmarks saw their biggest quarterly losses in 2 years, ranging from a 4.6% decline for the S&P 500 to as much as 9% for the Nasdaq Composite. The biggest economic development in March came from the Federal Reserve, which raised interest rates for the first time in almost 4 years, after having slashing them to near zero at the onset of the COVID-19 pandemic. The move was expected. Fed Chair Jerome Powell had been signaling a March rate hike since the winter, and investors took it in stride. The Fed envisions hiking rates throughout 2022 and lowering its record $9 trillion balance sheet in an effort to tame sky-high inflation. The concern, though, is that the Fed may go too far and spark a recession. Meanwhile, Russia's invasion of Ukraine continued despite intermittent peace talks, threatening the European economy as well as American business investment and consumer spending. Inflation remains the biggest hurdle. Americans are feeling the pinch of higher prices. 65% of adults believe the rate of inflation will go up in the next year, according to the latest Forbes Advisor Ipsos Consumer Confidence Weekly Tracker. That matters for market participants, since high levels of inflation can negatively impact both spending, which accounts for about 2/3 of gross domestic product, GDP, and consumer sentiment. For instance, February retail sales came in below expectations, thanks in large part to consumers dealing with higher prices. And the Fed lowered expectations for GDP growth this year at their March meeting. We're cautioning investors to not discount ongoing inflation and rising prices even as the Fed starts to make these moves on interest rate hikes, said Greg Bassick, Chief Executive Officer of AXS Investments. While the Fed doesn't convene again until May, some market participants are clamoring for bigger rate hikes, in the magnitude of 50 basis points, as opposed to the 25 basis point increase seen in March. By year-end, traders see a greater than 66% probability that the Fed funds rate will have a target range of 2.50% to 2.75%, which would be the highest since 2008. Before then, expect a lot of continued focus on two inflation reports: the Consumer Price Index, CPI, scheduled for release on April 12, and the Personal Consumption Expenditures, PCE, Price Index, scheduled for release on April 29. Is the bond market telling us something? The bond market is flashing a signal of a possible recession as the 2-year and 10-year Treasury yields have inverted for the first time since 2019. An inverted yield curve occurs when rates for shorter-term bonds are higher than those for longer-term maturities, and it can indicate possible trouble ahead, although analysts caution this is only one among many predictors of recession. The pace of economic growth had largely taken a backseat to other concerns in recent months, including geopolitical risks, namely Russia's invasion of Ukraine and the declining number of COVID-19 infections. These factors are among the main drivers of the stock market right now, according to Bassick.